Introducing Rodney Walt, head of private wealth at EG and a game changer in the investment management industry. Rodney is a divisional director and head of private wealth at EG, a leading investment manager and developer with over $5.1 billion in assets under management. Over the past decade, he has emerged as a driving force at EG and the private wealth division. With a keen eye for opportunities, Rodney combines decades of experience and an entrepreneurial hunger and agility, all focused on growing the wealth of EG's esteemed wholesale investor clients. As a divisional director, Rodney champions a disciplined, data-driven approach, continuously seeking ways to deliver exceptional results. Notably, Rodney has spearheaded EG's foray into cutting-edge realms of PropTech and fintech innovation, propelling the company's strategic investments in globally renowned tech platform Willow. More recently, he's moved into the business world of private lending. And with Rodney at the helm, EG's private wealth division enters an exciting era of growth and prosperity. Rodney, welcome to the show today.
Thank you very much, Dom. That's probably the longest introduction I've ever had, and I might keep that as a recording. Thank you.
You can play it to yourself in the mornings as you get up.
The motivational start to the day.
Look, I thought it was really important to have you back on the show. I'm lucky enough to just kind of give you a call and every now and then, and I get to get a lot of your insights from you and your team. What I really value about you and talking to you and your business is you do have a data-driven approach, but also I feel like you're a sensor out in the market. You talk to banks, you talk to builders, you are a developer, you talk to tenants, and you've got a very keen insight into what's happening in the market. And I like talking to you because I feel like you give me like a quick read on what you're seeing, what you're feeling, and you bring things back down to earth for me. So out there's a lot of confusion. We've seen, I think, 12 or 13 rate rises. We may see another couple coming up. And we're still in an economic environment where it's still quite strong. You know, inflation numbers came back just the other day where they're a little lower than expected. But I can't really tell what's up from down. And I guess I wanted to get your sense on what's happening out there and what's your read.
Thanks, Dom. I definitely agree with you. It is hard to make heads or tails of where we are in the cycle. Lots of recession talk, and sometimes when you keep talking about a recession, you almost propel yourself into that future vision of a recession. For me, I suppose the challenge, obviously, as you addressed it, being the 13 interest rate rises, it certainly caught a lot of people off guard. And I suppose my challenge is trying to understand the rationale behind the rate rises. When you think about what are the three biggest driving forces behind inflation, you've got fuel, wage growth, and rental growth. And well, with fuel, obviously the war between Russia and the Ukraine has certainly had an impact, and that will continue to have an impact while there is dislocation happening over there. Wage growth, people are needing more because of the inflation. And then you've got rental growth. And the challenge that I see here in Australia is that we don't have a built-to-rent market in its truest sense. Whereas in the US, you do have a very well-established market. You've got a Fannie and Freddie Mae, who are effectively government organizations that help fund multifamily owners, to providing them a lower cost of capital to fund their multifamily developments. Here in Australia, it's largely investors, people that you guys attract through Wealthy platform, who are owning these properties and then renting them out. And the challenge there is, as you increase the interest rates that they have to pay on the properties, they're just going to pass it directly on to the tenants. And being a renter at the moment, I've just seen our rent go up 18%. And that is a real challenge that you have in the marketplace. So that is going to continue. And I think that we're almost going to have to learn to live with higher inflation. And by increasing rates, it's a bit of a circular reference. If you're sitting on your Excel spreadsheet, as you increase it, you've got too many other variables that are increasing it again. So not quite certain that we're addressing the real problems at this moment in time. when you go out in Sydney, doesn't matter what night of the week, you find that in Sydney CBD, restaurants, or some restaurants, are still absolutely packed. Certainly out in the mortgage belt, people are struggling and people are feeling it. And when you've got people who are on reasonably large salaries saying, well, we're cutting back, you know that there's a real problem in the economy. So hard to really get a true sense of where things are. So I'm similarly struggling as to which way is forward and which way is back in the current environment. And hence why I suppose for the last 18 months, if you ask, I haven't done a single real estate equity deal. We just haven't found value. And while I had a whole bunch of investors last year, April, May, put me through the ringer, and why haven't we found a deal? I suppose, hadn't found value in the market. We continue to look and search and review number of deals, but actually finding something that stacks and going to deliver a return has proven really challenging on the equity side of things. And as you alluded to, we've really been focused more of directing our investors into short-term private lending and private credit, as we see that that's a better place to be playing while we try and work out where the world is actually heading.
There's a lot to unpack there. As you said, it feels to me that interest rate rises are having an effect of actually driving up inflation in many instances. And that is the only mechanism that the RBA can use. And it's the current inflationary environment sits kind of outside of what they can control. And you pointed to something really interesting, which is that more investment properties are actually needed in the market in order to have a deflationary impact on the rental market. And you said that through build to rent. The fact that we don't have much build to rent in Australia, it is a burgeoning space. There are more build to rent investors and developers coming into the market. But I guess I want to ask you a bit of a question. It wasn't on our little cheat sheet, and I don't want to get into politics, but there's a lot of chatter on the sidelines and a lot of blame where people are trying to go after investors by cutting into, say, negative gearing or cutting into different tax incentives that homeowners and investors get. And I've kind of had the thought that that's probably the wrong way to go about solving a lot of our rental crisis or trying to put rental caps. My thoughts are that we should simply work on stimulating the amount of properties that can come onto the market, increasing supply. So I guess the question in all of that is, as a developer, as a funds manager, are you finding it harder to get supply onto the market? And what kind of barriers are out there for the average mum and dad out there thinking, well, why can't you simply go and develop more property? What's the problem?
In short, the planning process here in New South Wales is really appalling. And unfortunately, it takes way too long to get planning approved. And we've been very, very slow in developing out more new developments for people to rent. And I think the challenge has been that whether it's this government or prior governments, that hasn't been corrected. Beyond that, we really took the axe to foreigners owning real estate here in Australia. And by meaning that we weren't allowing those developers to get those pre-sales through that could ultimately deliver rental accommodation, a lot of developers took their foot off the gas in terms of developing if they could get approvals through. So we've got a massive shortage of new stock. You've got the government announcing massive increases in immigration, and you kind of wonder where are all these people are all going to land and where are they going to live? And that's just going to continue to drive the rental higher because of the shortage of around. Hopefully there are some changes coming through, and certainly Chris Minns seems to be wanting to make changes. Whether they can be effected fast enough is going to be the question. But the planning process needs to be changed to really address the shortages around.
Now, you invest in a variety of different things. EG has, I can't keep up how much you have under funds under management, so I'm always a bit cautious when I say the number, but billions. And you've spent, you invest in tens, hundreds of millions of dollars. Where do you see opportunities in the real estate market? What do you see as good quality investments in property?
So that
Loaded
becomes a
question.
challenging question in the current environment, particularly given where debt is, particularly from my side of the business. So excluding the institutional side of the business, which is the large part of the 5 odd billion that EG has under management. For my side of the business and the private wealth, when you start thinking that all-in debt costs are sitting around that 6%, very, very hard to make equity deals stack. And particularly if you think that you're going to have 2 or 3 more rate rises this side of Christmas, potentially, where the types of returns that you need to generate. And hence why I really focus more on the private credit side of the business and for opportunities right now until debt really settles down. You need to understand where the risk-free rate of return is going to be, and until then, really challenging to see opportunities on the equity side. That being said, I mean, we utilize and our technology, our Prisms platform, our proprietary property risk management software has really been at the driving force of how EG's evaluated risk in real estate and part of the assessment on all equity deals. We continue to look and scour the market for opportunities. I think that certainly there's an interest in the build to rent sector, needs to be solved, haven't quite got the right formula in terms of the land value costs associated with it. And obviously construction costs at the moment really still pretty high, and supply chain constraints around delivery of product and subbies fees that they're charging, really a challenge in finding a development that actually works. Like the healthcare sector, rental growth in industrial has been fairly strong up until now, but starting to feel that there are a few cracks in that growth. And I was back in the US in February, and there were a number of groups that we met with that were looking at the industrial sector, and I was looking at a number of deals where the initial yield was below what the debt costs were, and they were very much blasé in that, don't worry, it will be all okay based on the rental growth that you'll be able to achieve on these properties. And I've never been one to really like looking at buying properties where my debt is going to be higher, and I'm very much reliant on one trick being that rental growth will save me.
So at the moment, you are sort of sitting on the fence, watching all these variables. You're saying construction costs are high, land values are quite high, debt costs are quite high. And although we will probably see rental increases in industrial and in residential property, it's just hard to make a deal stack at the moment. So that's why you've kind of gone into that debt space, and you may as well be part of that debt game rather than fighting against it.
Well, I don't think we're ever fighting against it. I mean, I think we've been looking at the debt space since 2016. I very much remember sitting with Adam Gahar in a meeting where we met with a fund manager in the US who played on both sides, had a credit book as well as an equity platform. And I remember Adam very clearly saying at that time, there'll be a season for debt and there'll be a season for equity. And right now we're in the season for debt. And even in 2020, when I established Private Wealth for EG here back in Sydney, we very much looked at setting up a private lending, private credits platform. The joint venture with M Squared really has happened over a 12-month period. And I think that that's really proving to be the right space to be, and where I believe that if I can generating returns for my investor between 8.5% and 12%, first mortgage with personal guarantees, I think hard for equity deals to stack in the current world.
Now, that's a really interesting position to be in, because then you're, as the first mortgage, have a position, if that person falls over, you essentially take the asset, right?
I mean, there's a well-trodden path here in Australia. It's not as simple as you take the asset, but you have the asset as security, and you'll go through the process of foreclosing on the property. Unlike the US, where you actually do end up owning the property and whatever equity is in it is all yours. But I think that right now, until we understand where the risk-free rate of return is, very challenging to do equity deals. On the debt side, well, if I'm providing those types of opportunities and they are based on where the bank bill swap rate is and has the flexibility to be variable, investors benefit as rates go up. And hopefully, based on the two sandboxes that we're focused on, not only utilizing our in-house Prisms platform on the private credit side of things and making those assessments, but also EG's equity lens in terms of particularly the commercial real estate opportunities that we will look at, we're able to really make a very clear assessment on a keys handed back scenario. That's not how you want to go into deals, that you've got the keys handed back to you, but certainly having an in-house planning team, in-house asset management team, leasing team, as well as a development team can certainly help us if we did have any of those commercial properties handed back to us.
So my passion is residential real estate. I do love commercial. I'm more interested in as my portfolio has matured, I've made investments in commercial real estate. I've invested with your business, and that's been a great experience. The question I want to ask is, what advice would you give, or what hints or tips would you give to people wanting to enter the commercial real estate space?
I think entering the commercial real estate space, obviously, as you have and you've advised a number of your investors, is really to try and do it with somebody who has an experience in that space. Certainly is helpful. It is a transition from residential to commercial. Having the right team on board in order to assist you navigate leases, understanding the difference between gross rents and net leases, incentives that need to be paid, the structuring of the deals is really, really important for someone new to the space. And understanding and building out a team around you that can assist you, be it through the legal contracts, through leasing, and the challenges that you might have transitioning from and effectively bridging the gap between resi to commercial.
What do you think is the single biggest difference between residential and commercial? There's 100 different things, and I talk about them in my book, but
yes.
You've been doing this a long time and on a huge magnitude. For the unsophisticated investor, what for you are the big differences there?
Well, I mean, I suppose very easy to understand buying a residential unit, renting out the unit, collecting that income, and being able to sell it. And the yields have been relatively low in that space for a number of years. But you had in Sydney, Melbourne, you've had massive rental growth, or across Australia, you've had massive growth, not only on the rental side, but you also had capital gains growth. So it's proved to be a very successful journey for a number of people. On the commercial side, we've generally, prior to the massive interest rate rises, had a higher income yield that was able to be generated from those returns, and hopefully a more stable, if depending on the lease term that you have and the tenants mix that you have, a more stable rental opportunity to collect from those tenants. I suppose there's always been a mix of it in my own personal portfolio, but as I've spent more time building these out for a number of the family offices, transition more of my wealth into commercial real estate investments.
Okay. Now I want to shift gears a little bit away from real estate and ask you some more personal questions. You've built a great business. I've known you for quite a while now, and it's been great to watch that growth and that progression. I've seen you travel overseas, you work with international investors, and you're now trading tens, hundreds of millions of dollars worth of real estate and other sophisticated types of investment. What do you attribute your success to? What are some of the core qualities or things that you've done that you attribute your business success to?
Wow, good question. I suppose for me, it really has been about working with great people. And I think that I've been fortunate enough to really have found 5 mentors that I really do value their opinions. I think having someone that you can trust and know that you back them and they back you entirely. A couple of gray hairs who've been through a few cycles, who've seen a few things, who can share experiences with you and help you navigate challenges that occur along the way. and keep you calm, because at the end of the day, better decisions are made when you're calm, and you know that you have a supportive collective group around you. So I've been very, very lucky to be part of the EG family for 13 plus years. I've known Adam and Michael for 16 years, and have very much embedded myself in the organization. And I think where you work with good people makes the journey a lot more fun.
Yeah, and that was a really nice way to deflect a lot of your success to the people around you, which is a very humble way. And this is one of the reasons why I like working with you, Rodney. But that's invaluable advice. I couldn't agree with you more. No great thing really is done by yourself. We're always standing on the shoulders of titans. So good advice. I'd like to ask you something else. So what has changed for you personally between when you started and where you are today?
Well, where I started, I suppose it's been a long time with EG, but where I started with private wealth was really just an idea and a vision, and saying to Adam and Michael, I think that we've got an opportunity to play in a space that is below where our institutional partners are wanting to invest. And I've built a business that has very much been a personal business. I know my investors personally, I know their families. Many of them have been to my house, I've been to their houses. And I think that that's been probably the difference in terms of actually being able to create something in the way that I wanted to, where it's part of a larger family group or tribe, essentially, to help them grow their wealth, understand what they're looking to achieve, and trying my very best to make sure that we can navigate them into the right opportunities that meet their investment criteria.
Okay, so it's been a personal journey for you, and basically it is working with people that you enjoy working with and having that tailored experience along the way.
Right.
Now, I've got two more questions. Thank you for your time. Tell us about a time where you've made a mistake in your life that's informed all of your decisions going forward.
Wow. I think in terms of a mistake, I think we all are susceptible. We all are susceptible and will make mistakes along the journey. So I think there are many mistakes that I've made along my journey. I think the only that you can do is just be honest and truthful with yourself and those around you about where the mistakes are and how you're going to navigate to correct those mistakes. And I think it is one thing that EG does very, very well when we've done a deal is really doing lessons learned. So things that you've done in the deal, things that went well, things that didn't go well, things that you can improve on. And by having a cheat sheet or a map of all of these lessons learned over time, you start building them into your database or into your intuition in terms of, okay, I've seen this before, or when I write a contract, I want to include this term because I saw it work well for somebody else when we were on the other side of the fence. And I think those are the things that you need to jot down, have at your hands, particularly as you try and build your wealth or do anything in life, is really understand and reevaluate all the time, and try and build from there. So doesn't quite give you a pure example of when I've done wrong, but there's been many opportunities where you haven't, or I haven't. We try and navigate up to the best that we can and talk to those around you where there has been errors in your way, and be able to say, okay, well, this is what we've done and how we're going to navigate to make sure that we get to the right outcome.
It's a very good answer, Rodney. There's something that we can take out of that, but I want to press you a little bit.
Yeah.
I'm interested in pressing you because I know at the back of all of our minds, especially if you've been doing something as successful as you have for a long time, there has to have been a moment where you thought, fuck. and that for you, you're like, I will never make that mistake again. Like some things, even it's a little anecdotal story where, hey, I did this thing and I'm now better because I'm not going to do that again. I'm not going to go and eat Macca's at 3 a.m.,
Eating Macca's at 3 a.m. is never a good idea. Clearly when I started private wealth, there was maybe a little bit of apprehension internally about creating a private wealth division, and I fought hard to be able to set up the business. 2020, we kicked off and we bought our first asset. And the first asset was a property up on the northern beaches of Sydney in Belrose, a multi-tenanted industrial estate. And why did we buy it? I suppose we liked the asset. We also had other institutional assets on the northern beaches that really gave us a great insight into the tenancies that wanted to be up there on the northern beaches. And you've got the ocean, you've got the mountain and the Ku-ring-gai National Park. And we bought this asset, and it had a 1.1 year weighted average lease expiry on the asset when we acquired it. And within the first couple of weeks of owning the asset, one of the largest tenants gave notice. And it was a little bit of my oh no moment of, okay, I've gone and raised all this money. These investors have backed me. And now what's going to happen? And then 2 weeks later, we ran into COVID. And COVID shut us down. And certainly there were a few sleepless nights. And that was pretty much my, okay, we're in this situation. What are we going to do? How are we going to navigate to get ourselves out? And I suppose, once again, I draw on the broader EG team and the fact that we had done our homework and we had done a lot of the grunt work through what we knew was from our other assets on the northern beaches. Our other tenants were wanting space. There we were, with the tenants handing in notice. They were moving out and vacating on the 31st of March. And on the 1st of April, we had Fantastic Furniture come up and take up a 10-year lease on their property. But through that time, I think taking a very personal stance and really talking through with a number of the investors that had backed us on the journey, saying what we were going to do. There were a lot in that first couple of weeks of COVID, really stressful moments. And okay, well, I've gone and done this. This is my first asset. And is the world going to come to an end, as we all recall? But I think it's about just getting on the phone, getting on the front foot, making the phone calls, making sure that you've done your homework, that you can navigate the paths, because it's not a straight line journey that we're on. We're not getting out of here alive. So you've got to be able to navigate that journey and that path and be honest at all times with yourself and with those that are around you, and work the best way that you can to navigate. We got out and we delivered an amazing return. But I think, as you know, life is just a wave, and you've got to, there'll be highs and lows along the journey, and we try and make the most of it while we're here.
So it sounds like it was a bit of extreme ownership there, and something that keeps on popping up is this sense of you personally owning it, and having those relationships with people, and really diving deep into the thing that you're working on at hand, and not kind of sitting back. You really pressed forward when things got hard. You then leaned in even further. So that's a really good story. Thank you for sharing that. And then I guess this is my last question. What advice would you give to new investors and homeowners so they don't fuck up their next purchase? That's a shameless plug for my book.
For your book. Wow. Well, I think you've got to read Dom's book of how not to fuck up when buying your next property. I think I'll probably just say it really comes down to having that network around you. If you're doing something for the first time, understand those who have done it before, learn from their mistakes. Everyone has made mistakes when buying a property. Have the right team around you, have the right lawyer, have someone that has been trusted, has been vetted. Make sure that your conveyancer is good. Make sure that you have done your building and pest inspections, that you know what you're getting into, and that you can work and have a buffer. I think knowing that you've got something at play that you can handle, not having a tenant for 6 months, or having some special levy that gets thrown upon you, and doing as much work as you can up front to understand the contract. I think a lot of young people hand that over to their lawyers and say, okay, well, they've read it. I haven't. I don't need to. But try and go through it. Ask questions. I don't understand this. I think a lot of people are very supportive when you come back to them and say, I've read this. I don't understand this. Should I be worried? And I suppose something else that has got me through a lot of things is really your gut and intuition. If there's something that's niggling at you, annoying at you, am I missing something? Ask another question.
Really good advice. Sounds like you've read my book. No,
I was very lucky to get a signed copy, which will be highly valuable in time.
Really, really good advice. I think it's something that comes up time and time again, where the people that you have around you make the journey so much better, more enjoyable. And when you do encounter issues, it's good to have someone with a few gray hairs that have encountered those issues in the past, because it is cyclical. You will see the same things come around time and time again. The other thing that I really like is that sense of ownership. Taking ownership of the contract, taking ownership of what you're actually buying, and not outsourcing the important decision to someone else. And even if you don't know it, diving in and asking the people around you, you are employing these experts. I imagine that a lot of what you've learned, Rodney, is not through university. It's through picking up a contract, talking to the solicitor, talking to the property manager, talking to the bank. These professionals will quickly make you an expert by going through these types of deals.
Absolutely. I think, and that's it. I think the whole life of your journey, and particularly as in your young part of your career, and that's why I think it's so important for young people to be back in the office, working with people in an office where they are actually listening to conversations, understanding how interactions happen. And I think you can take that into the rest of your journey as well, as you build out your own personal wealth. But I think if you're sitting behind a computer screen, very, very hard to remain focused, engaged, and understanding those nuances in negotiations or discussions.
That's interesting. I hadn't thought about it like that. I value working from home and being able to do everything myself. But I think it's a bit different once you've had a career of 10 or 20 years compared to early days, where I now think back, I was privy to a lot of conversations. I wasn't in them, but I heard them. And that gave you a lot of insight, just sitting in the room and hearing what's going on and why they're making those decisions. And I think that's definitely a cause to get people back into the offices. Maybe not me, but other people. Rodney, thank you very much for your time today. You're always a great guest. You're full of insights. Anyone that's out there that is a sophisticated investor should be reaching out to EG. They've got EG Private, Rodney, and the team. For all of you out there that are looking to go buy, invest, buy their own home or invest, good luck, stay safe, and we'll see you on the next podcast. Catch you all later.
Thanks, Dom. Thanks, everyone.